Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, September 4th. Yesterday, softer than expected job openings data from the US gave a small relief to developed markets' long maturity bonds, but upside risks here prevail and they actually do threaten to reverse the post-April equity rally across the globe. So we will talk about all that and alternative assets to hedge against a potential meltdown across equity markets. But before we do, please keep in mind that opinions are my own and this is not financial advice. So major European and US indices made a recovery attempt yesterday as the long maturity yields came off to provide some relief to investors and Magnificent Seven stocks jumped 2% together thanks to a 9% rally at Google after the DOJ just announced that Google can actually keep its Chrome, but it will have to share its online search data with its competitors. So that was kind of a huge relief for Google and its investors, as losing Chrome would mean losing the major interface of the company and would obviously cost Google a lot of money. No wonder Google shares soared to a fresh all-time high level yesterday. Also, Apple gained 3.8% on news that a US judge actually stopped short of barring its juicy search arrangement with Google. As such, yesterday's decisions came as a hint that the DOJ under Trump's administration will be more friendly to the US technology behemoths. And that's obviously good news for US technology investors. The bad news is that these technology companies are already trading at super high valuations, meaning that all of these antitrust pros over the years did little to shed value, and investors are obviously becoming increasingly worried that some of these technology names have indeed become just too expensive. But you know what? Expensive or not expensive, many investors around the world in these big names have a hard time finding exciting alternatives elsewhere, explaining also why investors around the world keep piling into these US technology stocks despite their sky-high valuations. But anyway, today's story is not about technology stocks, but it's mostly about the bond markets and the global bond sell-off that we've seen since a couple of weeks now, and that's weighing on risk appetite across the globe. The developed economies' sovereign bonds are having quite a hard time these days, with long maturity yields at multi-decade high levels on, as we discussed at yesterday's Market Talk episode, ballooning debt, political difficulties in these economies to rein in, and structurally higher inflation rates as well. So to service the rising debt and the rising interest payments due to higher interest rates, well, the countries of developed nations are brought to issue more government bonds. And that's obviously also adding to the upside pressure that we've been seeing in the yield since a while now. So the long maturity bonds suffer the most from this dynamic. As such, the US 30-year yield yesterday flirted with the 5% psychological level before declining on softer than expected US jobs openings data, a softer than expected JOLTS reading, warning that job openings fell more than expected in July and to the lowest levels in almost a year, actually did reinforce the idea that the US job market is, yes, indeed slowing. So the US 2-year yields tanked to the lowest levels this summer on rising dovish expectations as the probability of a 25 basis point cut in September Fed meeting climbed to 95%. Now, a soft ADP read today and weak official jobs data due Friday could also further support this trend and pull the US 2-year yield lower. We are just to see whether the steepening of the US yield curve will slow now that the 30-year paper pays about 5% return on prospects that upcoming rate cuts from the Fed would boost medium to long-term inflation expectations and eventually keep the long end of the yield curve under upside pressure. Because indeed, the 2-year yield just pushed lower this morning while we see a certain rebound in the 30-year yield as soon as this morning. In the FX and commodity space, well, the softening Fed expectations and expectations of Fed cuts continue to weigh on the US dollar, and US dollar was softer yesterday after the JOLTS data, while gold extended its rally to $35.78 per ounce level, a fresh all-time high level backed by the soft US dollar, but also by rising worries around the world on how the so-called developed governments will manage to pay back their ballooning debt and ballooning interest payments as well, and on the certainty as well that many emerging market central banks will simply continue to replace their US Treasury holdings by gold, which is an asset that doesn't depend on a government's will actually to keep its finances in check and or to freeze a foreign central bank's US Treasury holdings, for example, on geopolitical issues like it has been the case, remember, with the Russian central bank a few years ago at the start of the war in Ukraine. So gold doesn't have that risk. And this migration toward gold could further accelerate if Fed's credibility is put to question as a result of multiple attacks on its members from the White House. So there rises the question of whether Bitcoin could be an alternative to gold, because Bitcoin is also an asset that has no official ties to any government. But the problem with that is the US is now backing Bitcoin big time and wants to become the world's cryptocurrency hub. Therefore, if we see a deeper divide between the West and the rest, the emerging countries' populations could be forced to exit their dollar-denominated Bitcoin holdings, and that could eventually pose a risk to Bitcoin's popularity among the emerging market populations. And reports actually say that around 60 to 70% of crypto holders actually do live in emerging markets. But coming back to my sovereign debt and rising yields story, looking beyond the US, a benchmark for European 10-year yield actually fell yesterday as well, and fell despite looming worries in Europe of another French government collapse by next Monday if François Bayrou doesn't manage to convince the opposition parties that his plan is a good plan, while the Japanese 20 and 30-year yields also see some relief this morning, but near their highest levels in decades. So the sell-off in sovereign bond space will likely stabilize at some point in time when investors will be convinced that the yields are high enough to rotate into the government debt that has become just more risky than before. So in this environment, the corporate bond issuers are actually having their best life, to say the least. Yield spreads between the US corporate bonds versus their sovereign bond peers is at the lowest levels of the past 2 decades, and that means that the risk premium that corporations pay on their debt versus their governments is simply very, very little. But despite little compensation for extra risk taken for holding private corporate bonds, while high stock valuations, especially in the US technology-heavy indices, and crumbling trust in sovereign debt markets make the investment-grade space quite attractive these days, especially when the Federal Reserve is preparing to lower its interest rates. So the easiest way to go in there is to buy a investment-grade ETF like the iShares iBoxx, for example, which has been rising in tandem with equity markets recently, but trades with an almost 10% discount compared to its 2020 and 2021 levels. Now, note that the investment-grade bonds could also be a way for investors to hedge against a potential meltdown in the equities space, as these bonds are midway between equities and government bonds. They actually tend to move toward the same direction than equities do, but not with the same speed. So they will never give you the same upside exposure than equity markets and the same potential than the stocks themselves. But for investors who are actually looking for stabler investment options, they could be quite interesting, especially when the worries of a potential meltdown are mounting. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.